From New York City for our viewers worldwide, I'm Scarlett Fu. Bloomberg Real Yield starts right now. Coming up, the long-awaited and long-delayed September CPI report was benign, showing inflation at the slowest pace in 3 months, offering a path for the Federal Reserve to cut interest rates beyond next week's meeting. And some of the biggest voices on the street, they're weighing in on possible cracks in the credit market. We begin with the big issue, a softer than expected CPI print.
It's generally a better than expected report.
Inflationary pressures outside of, some tariff-related pass-through are pretty benign.
We're looking at this extra stale, backward-looking data.
We see downside risks to the economy.
The ingredients are there for a reflation or inflation trade in 2026.
And it's not just inflation, it's inflation plus growth.
A year from now, inflation will be convincingly down into the mid to low twos.
The bias is that it's going to be kind of a run it hot Fed.
We should be very careful about cutting into higher inflation.
We know the Fed's going to cut interest rates.
I'm not sure that Fed rate cuts really mean a huge amount for the economy.
There's going to be some shifting in how the Fed approaches things.
We're waiting for that next shoe to drop.
So let's dig into that latest inflation number. Cooler than expected basically across the board. The headline number rose 3% versus the expected 3.1%. And that's the case for the core number, too, which backs out food and energy costs. When you compare it to the prior month, we saw consumer prices rising 0.3%, while when you back out food and energy, again, core, they gained 0.2%. Better than expected. This inflation print have given traders the green light to cement their expectations for 2 more quarter-point cuts this year. Traders have also slightly shifted their timing for additional reductions in 2026. They're now expecting nearly 4 by June. Former Fed Governor Betsy Duke warns that the central bank should stay cautious.
The Fed would be well served to be very cautious in this environment. You might see dissents on both sides at this meeting. The reason I say that is because this meeting sets a pattern. So if your pattern is quarter point every meeting, that's hardly a cautious pattern in my mind. If you start setting up an expectation for more and more cuts, at some point, the majority of the Fed voters are going to feel uncomfortable with that pace. And then it's going to appear to be a hawkish turn.
All right, let's get into all of this now with Kathy Jones. She is Chief Fixed Income Strategist for Schwab Center for Financial Research. Kathy, good to speak with you. So this inflation report, as we've been saying, cements a rate cut for next week. But you marry that with the University of Michigan report, which paints a pretty different picture of an anxious, maybe even stressed consumer. Sentiment falling to a 5-month low. Inflation from the consumer's perspective seen rising 4.6% over the next year. How does the bond market reconcile this contrast?
I think it's a dilemma for the bond market, maybe more than is reflected in today's price action. But I think it's good to remember that inflation, although this print came in a little below expectations, is still pretty elevated, well above the 2% target that the Fed is looking for, and nominal growth is still pretty sturdy. So if you put those two together, I'm not sure the case for cutting makes a lot of sense. Yet on the other hand, consumers still have expectations that inflation's not going to 2% anytime soon. You could debate, which side of the fence you're on politically in terms of your expectations, but very little indication that the consensus is in aggregate that it's going back to 2% soon. So you really have kind of a situation, I think, where the doves can get their rate cut this next meeting, but after that, I think the battle between the hawks and the doves is going to be interesting to watch, because there's a number of people at the Fed now who've already expressed concern that they're cutting into higher inflation and elevated inflation expectations.
And furthering that idea, the White House has now warned that there won't be an October CPI report either. So we're missing that part of the picture, in addition to the fact that we haven't had any official jobs data either. So is a December cut less of a certainty now? You sound like you're not convinced.
Yeah, I'm not convinced. Of course, I don't have a vote, so it's not me. My opinion is I don't think the case is compelling for another rate cut after this next one. They've sort of already signaled that the next one will be a cut. But, as we go forward, you think about, well, what is the Fed trying to do with lower interest rates, right? To stimulate economic activity, to help the job market. And yet, what we're seeing is, it's not financing costs, it's not interest rates that are really holding back the economy. Maybe you could argue it's holding back the housing market, but there's also a supply-demand dynamic there that is at work. But you say, well, what's the purpose of lowering interest rates here, other than signaling that the Fed is concerned about the weakness in the job market? Financial conditions very easy. No one's having trouble accessing finance. So it's not a strong and compelling case when inflation is still elevated and nominal growth is still reasonably sturdy.
You had mentioned that the economy is doing fairly well. I wonder if AI spending, investment is making the economy look better than it actually is. I mean, we know that AI is where the major growth is now, but does it mask the economy's trouble spots, whether it's manufacturing, whether it's payrolls, whether it's worsening sentiment?
Yeah, all that CapEx, that's taking place right now, I think is a big driver for the higher GDP prints. And you do have this economy that's split between the haves and the have-nots. And that is, I think, we'll see slower consumer spending going forward than we might otherwise see, partly because the inflation effect is such that, from tariffs, it's just some consumer goods are getting priced out for lower income folks. Similar story, I think the shutdown of the federal government and the cessation of some of those benefits that people rely on could certainly curtail consumer spending going forward. Depends on how long that lasts and what the ultimate outcome is. So we do have this economy that is K-shaped, with certain portion of the population doing really well and CapEx driving economic growth. On the other hand, you've got basically stagnant labor market and softness at the lower end of the income spectrum. So it's a mixed bag, but generally speaking, does a Fed rate cut change that dynamic? And that's the question I think they have to ask themselves, the risk reward. Does it risk just sending inflation higher and not really solving the problems that lower interest rates may not solve?
Right. I mean, the key to all of this is what happens in the labor market, and consumer spending depends on people's jobs and their sense of whether their jobs are secure. We've heard from companies, GM, for instance, saying that's going to be cutting hundreds of salaried workers as part of its profit push. What are you hearing from companies this earnings season that has you getting a little bit more of a handle on what the labor market looks like?
Yeah, what we're hearing is selective cutbacks, but not widespread cutbacks. So that it seems as if it's a continuation of the no hiring, no firing environment that we've been in. Small and medium-sized businesses are suffering more than the large companies. Large companies are kind of moving people around to accommodate the changing economic environment. They've been able to parse their way through the tariff business to a large degree and manage through that. But small and medium-sized companies that have, much lower margins are much more affected by tariffs, by cutbacks in consumer spending that might be happening because of the federal government cutbacks. They're struggling a lot more. And, when you look at the regional Fed banks and when they do their surveys of businesses, you really see that dichotomy between the smaller businesses and the larger businesses. And that's where we end up with this standoff, I think, in the economy between those that are driving economic growth and those that are just kind of managing or trying to manage through economic.
Yeah, very well put. Kathy, thank you so much for joining us. Kathy Jones of the Schwab Center for Financial Research. Bloomberg this week hosted a future fixed income conference where I sat down with Greg Peters, the co-CIO at PGIM Fixed Income. We discussed a lot of issues, but primarily in this part of the conversation, risk in the sovereign debt market. Take a listen.
I do think what you're seeing globally is just the sovereign debt markets ultimately crowding out corporate debt. So it hasn't happened. There's so much capital in the system right now. But you look at just spending plans across the globe, including the U.S., and there's no retrenchment, right? So take Europe as an example. So Europe has been, well, let's take Germany, for example, has been the bastion of fiscal restraint, arguably too much. But they can't afford to do that anymore, right? They have to spend on near-term, energy, securitization, future green initiatives to fund. You have military, right? You have all these other things where there's a forced spending. And so I think that forced spending globally, particularly on the developed market side, will crowd out capital and credit. And that's where I think you're going to see the most dislocations and the volatility, more so than the credit markets.
So in the sovereign debt market, where do you want to be on the curve? How do you want to go about spreading your risk?
Yeah, so I'm still, notwithstanding my previous comments, I'm still, worried about the back end, right? So I don't want to really play the back end. I think the closer you are to central bank policy, the cleaner it is, right? The better the correlation, the more measurable beta. When you go out the curve, you're influenced by term premium, all these other things that are often outside your own control. So away from kind of the relative value stuff that we do, I like being closer to the front end as I can, and kind of go out to maybe 10 years. But away from that, I think you're beholden to factors that are well outside of your control, and that just worries me intrinsically.
And that was Greg Peters of PGIM Fixed Income speaking yesterday at the Bloomberg Future of Fixed Income Conference. Coming up next on Real Yield, the auction block, where some of the biggest voices on the street weigh in on the potential cracks in the credit market. This is Real Yield on Bloomberg. I'm Scarlett Fu, and this is Bloomberg Real Yield. It is time now for the auction block, where we highlight the moves in debt issuance this week. Let's start with sovereign auctions. The U.S. had sales of 20-year and 5-year TIPS. The 20-year saw the lowest yield since September of 2024. Meanwhile, the 5-year TIPS yield tailed, coming in about a basis point higher than the when-issued yield. In U.S. investment grade, weekly volume of $10 billion was short of the dealer's $15 billion forecast. This will be the fourth straight weekly miss. The names that did come to market included Truist, American Express, and General Motors. And over in high yield, borrowers are staying mostly on the sidelines after that supply boom in September. Just 3 deals pricing this week. Albertsons was one of the highlights, with a boosted sale of $1.5 billion that drew orders of more than $4.5 billion. There's that consistent story of not enough supply and plenty of demand. Credit concerns remain top of mind, though, with some of Wall Street's biggest voices now weighing in. Take a listen.
Everybody's talking about, oh my God, private credit's going to go bad. I do worry about one thing. I worry about those firms that don't have a driver's license, that have decided they want to get into private credit, have no way to drive, haven't passed a test or anything. And yeah, will they have problems? They could. I don't find it systemic.
These things are being sold aggressively. It's a wonderful product for people that have targeted rates of return needs, endowments, pension funds. But again, it's just something that worries me when equity rates of return are promised on credit instruments. Usually there's something you're not seeing.
Doesn't matter whether it's so-called private or credit and who the lender is. It is a full-time specialized job, day in and day out. The thing about fraud is you wonder whether it is one bad actor or it is some effect of circumstances that are stretching the company's finances and making them take risks that they otherwise should or would not do.
Let's dig into all of this with our credit roundtable. Michael Best is a high-yield portfolio manager at Barings, and Meghan Robson is head of U.S. credit strategy at BNP Paribas. Clearly, a lot of prominent voices expressing some reservations now about private credit. Let's start with the public credit market. The high-yield credit spread is finally starting to widen, Meghan, after some high-profile corporate collapses, fraudulent loans at regional banks. Is a slowing economy, though, especially the parts that serve lower-income consumers, kind of the bigger threat?
So, well, first of all, thank you for having me. So we still are confident on the economy, actually. And in terms of some of this spread widening in high yield, we see it as an opportunity to add. So we have seen, following some of these headlines, investors have de-risked. It means they've reduced some of their exposure to riskier parts of the market. Spreads have widened. And the reason behind some of that de-risking, we think, is more related to the 2 bankruptcies that recently happened, some of the headlines around regional banks. The exposure in public markets to those areas we think is relatively low. So think about subprime consumer lending and auto lending, less than 2.5% of the high yield index. And so it's not an area we think can drive weakness in public markets. And actually, U.S. high yield to us looks attractive here.
Michael, what about you?
Yeah, absolutely. I think Meghan brings up some great points there. It's a smaller part of our market when we're talking about some of these things that are happening. But obviously, I think it's incumbent upon investors to work with managers who are sort of picking through the index, picking through the individual credits. I think some of the earlier guests that just came on were talking about, this is a labor-intensive business in terms of picking through these companies and sectors. But to some of Meghan's points there, I think that, particularly in the auto sector, in the subprime credit space, as well as some of the AI risks that are out there, I think those are things that investors really need to roll up their sleeves and do work on and pick managers that are doing that level of work.
I wonder, though, whether in this kind of risk-on environment, you do expect to get paid more for taking risks. So even though high yield spreads have widened a little bit, they're still pretty much near historically tight levels. Michael, what's the case for adding to high yield when investors can sit back and park their money in investment grade and do well?
Yeah, well, I think in terms of the case for high yield right now, I think I agree with Meghan that this spread widening event sort of creates an opportunity to add some selective exposure in some of these sectors and some of these companies that are going to be really isolated from some of this noise. So, I think that's a key aspect. I think the other key aspect to think about here is that is a much shorter duration asset class than it has been certainly in cycles past. And when we look at the high yield bond market, for example, we're at near record lows on duration. So you're buying a lot of bonds that frankly are likely to be called in the next 2 to 3 years. And you just don't have the ability to really lose on a credit basis or certainly on any sort of duration basis with those individual securities.
In 2020, 2021, where rates were really low, rock bottom, Meghan, companies went on a borrowing spree. There's now a wall of leveraged loans maturing. As lenders become more concerned about underlying assets and the state of borrowers, what's your sense of whether companies will struggle to extend or refinance this debt?
So far, they've had a very easy time refining debt. And if you think about the maturities that are due through 2026, the high yield market has already addressed the majority of those. So there is a bit of runway there. And think about issuance back in September. If issuers want to come and refi, they're able to do that and at attractive spread levels. So far, we have not seen any of the recent headlines feed into capital markets activity, and it seems to be still opportunities to refi for those that want to.
But a lot of that borrowing, Michael, moved to the private markets, which limits supply in public credit while demand remains pretty strong. So is the big picture of high yield spreads remaining, again, near those historically tight levels kind of distorted as a result?
Well, it's a little bit debatable whether or not it's distorted, but I will say that the markets have become higher quality. So a lot of the private credit market taking some share, if you will, from I'll pick on the leveraged loan asset class for a little bit in terms of where it's been taking some share. It has been on those smaller companies, those B3, B- rated credits. And again, to some of the reasons that justify tighter spreads overall is, generally speaking, the market has gone up in both quality in terms of absolute rating category, as well as gone up in quality in terms of larger, bigger scale businesses being involved. So I think that has had some impact. But I think one of the things we just frankly haven't seen to really drive supply has been large-scale leveraged buyout activity. Obviously, there's one out in the market right now that's going to set some records here, but it's a much larger business, much bigger company. And when you look at the capital structure of that business, they're also bringing correspondingly a much larger equity check than maybe we saw in 2021 during some of those sort of boom LBO years.
Yeah. Referring, of course, to Oracle here. We are in earnings season, Meghan, as we wrap up this conversation, and we've already seen some regional banks deliver some surprises to the downside, especially with those fraudulent loans. Are you worried about potential triggers being revealed in any way, a reaction that might not be easy to position for?
So far, not. We've actually, we have seen some concerns, which you mentioned, but also other regionals, the higher quality regional banks, actually came out with positive results this week. We saw a few deals in the market that were received well. They were oversubscribed and with a relatively low new issue concession. So I think for the regionals, we're really watching a bearish case would be actually rate hikes. And that could cause some of the problems that we were concerned about earlier on CRE. But for now, our base case is actually for continued rate cuts. And so we think there will be continued relief to that area.
Yeah, CRE feels like so long ago at this point. Thank you so much, Meghan Robson of BNP Paribas and Michael Best of Barings. Really appreciate it. And if you can't get enough talk on credit, check out the Bloomberg Credit Edge weekly podcast on the Bloomberg Terminal and wherever you get your podcasts. Still ahead on Real Yield, the final spread the week ahead. With a Fed rate decision on deck, we go through some of the data points and events on the calendar. This is Bloomberg. I'm Scarlett Fu, and this is Bloomberg Real Yield. It is time now for the final spread. The week ahead. Coming up on Sunday, we get a crucial midterm vote in Argentina that the U.S. has a financial interest in. On Monday, the ASEAN leaders hold their summit and the Future Investment Initiative Forum takes place. Tuesday, NVIDIA holds its GTC event, and we have the APEC CEO Summit plus earnings from BNP Paribas, HSBC, as well as Visa. On Wednesday, the Fed's rate decision takes place at 2 p.m. and Chair Jay Powell speaks at 2:30 p.m. And we get earnings, a big earnings day, in fact, for Mag 7 members Meta, Alphabet, and Microsoft. Let's move ahead to Thursday, where President Trump and Chinese leader Xi Jinping are scheduled to meet in South Korea at the APEC summit. We'll look for any kind of signs of progress on trade discussions there, any kinds of announcements, all of that on the table, plus more tech earnings from the rest of the Mag 7, Apple and Amazon. And on Friday, big oil names including Exxon, Chevron, and Dominion report. This is Real Yield on Bloomberg.